You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today, of course, is the day where we go through the week's topics and get an update on the economy from Zulfi Ali of Valerity Wealth. Zulfi, how you doing?
Hey, Buck. Great to be back.
How's Memorial Day there over on the East Coast?
Yeah, not bad. Actual Memorial Day, we got a lot of rain here in Virginia, but Saturday and Sunday were pretty decent, so I'm not going to complain.
Well, that's good to hear. What'd you think of last week's podcast? Or this week's podcast, I should say, the one we released.
Wealth transfer.
Yeah.
$100 trillion coming over the next decade, right?
To a bunch of socialists. That was the upshot. That was the upshot of the whole thing, is $100 trillion going to a bunch of socialists.
Well, they're young, right? So
Right.
they still have, they're not quite hardened from life yet. So they're altruistic. They want to do good for the environment, for the world, and believe in social equity and all that kind of stuff. Which is, I think, listen, every generation does that, right? We go through that process. It'll certainly be interesting to see how they develop in their outlook and their actions, particularly if they get a bunch of money.
Right. I mean, I know they didn't. Yeah. They're going to inherit $100 trillion. You go, you're going to have fun with that. Well, and I've mentioned that to the guy too, and he seemed to sort of downplay this. But like, to me, it reminds me of, okay, the 1960s, right? Free love and drugs and, and all the, Woodstock and all this stuff. And what do those people end up going and doing? They're doing all the things that these Gen Z people are now trying to undo. Right? Right. So I mean, I'm like, there's probably differences, obviously, in the generations, but anyway, there probably is some tendencies, although I'm not sure how long they last. I think that every generation, and I think certainly even us Gen X folks, for the most part, start more sort of open-minded and, sort of more socialistic and, want to do good for the world. And the next thing you know, you get a job and you see how much taxes you're paying and all the and your entire view of the world starts to change, and you realize how hard you're working. You want everybody else to work that hard and all that kind of thing, right? I mean, isn't that kind of what you experienced too?
I mean, I've had my own evolution. I think everybody goes through their own evolution. So I'm not, I think the areas where he's probably, got something more interesting to think about is the newer and younger generations, the millennials, the Gen Z. What they do have, what we didn't have, is technology on their fingertips, right? They've got mobile connectivity. They socialize through that medium. It's real time information. So I think there's some interesting things there. I do think there's probably a more lasting focus on environmental, global sustainability, that sort of thing. I think we're all kind of getting there anyway on that topic, but you could probably imagine the younger generations are going to have a bit more emphasis on that than we might, right? Growing up during the time periods that we did, when we didn't even really think about it when we were young, very much, other than don't leave the lights on because it'll waste energy. That was kind of the lessons that I remember. That was kind of the extent of it.
That was the extent of it, right? That was about it. But yeah, I mean, so what does your research suggest on these topics, though?
Well, listen, it is an unprecedented quantum of wealth transfer that we really can't see something going back that is in this size and magnitude, and it's going to be happening both in U.S. and in Europe. right? So a lot of European countries, and it's all because of post-war dynamics. From what I've seen in the research, not all of this wealth is going straight to the millennials and Gen Z. About half of it should be from baby boomers to Gen X. So
yeah,
I think,
he completely left us out of it, like we were worthless.
Yeah, I'm not sure how that works, because the baby boomers, for the most part, their children are Gen X, right? There are some probably millennials, so I don't think they're just going to skip a generation and hand it off to their grandkids. A lot of that wealth is coming to Gen X first, and then we'll see what goes from there. And you already defined Gen X as being less altruistic and wanting to keep wealth for ourselves. But at the end of the day, it's let's see how it all goes. Yeah, I don't think people that inherit wealth are just going to turn around and do only social causes with it. I do think they all of a sudden grow up and get serious if they've got to manage what they're gonna retire on, or what is something that they could leave for their own children. So I think they start to get more serious about looking at how to deploy that.
So I mean, I guess the takeaway in your mind for sort of investors on this topic would be what?
Well, first, I'd say, on the general topic of wealth transfer, I'd go back to, your prior podcasts about making sure that people are prepared for that, right? You want to do a wealth transfer that's efficient from a tax perspective, from a timing perspective. You don't want your heirs to be waiting while there's a probate process going on and all that kind of stuff. So I think there's some kind of high level lessons here. One is, if you're going to be a transferer of wealth, then definitely get your stuff in order so that you can have a smooth transition the way you want it done. Also say, for those that are expecting to be recipients of wealth, you should be thinking about the same thing with respect to those who would be transferring the wealth to you, because they may not be thinking about making sure everything is done as efficiently as it should be and that sort of thing. So those are conversations that, as families, you want to have. You may want to get a financial advisor involved in there that can often help alleviate awkward discussions, particularly if you're the recipient who needs to bring up a topic. Having someone that's professional can also help.
I can hear you offering your counseling services, so you don't have to say, you don't have to be like, hey, Dad, when you die, can you just make sure that your paperwork doesn't screw me over?
Yeah, exactly. It's a touchy subject, right?
Yeah, and for sure.
It becomes presumptuous at times if you're just going to assume that you're going to inherit everything. So, having a third party that might just be coming in from an informational perspective, it might help the situation.
Right.
So yes, so I am here if that's something I can do of service. Beyond that, I think from an investment perspective, it's kind of hard to really pinpoint what kind of impacts that would have. I mean, again, we've got the theme of an aging population. We've talked about there are themes, investment strategies and themes that you can deploy into, whether that's health and wellness, leisure products and services, migration of the population going to the Sunbelt states and the demand for housing and all that. So some of that has been playing out. Some of that is still going to continue. So that's one thing. But actually factoring in the wealth transfer, I think it's harder to figure out exactly what's going to happen. We do know that baby boomers have heavily relied on stocks and bonds as in their portfolios, alongside some real estate, typically their main home, but it's stocks and bonds and their main home are kind of the big pillars of their investments that they will be handing down. We do know that there are studies that say that the millennials and Gen Z are actually much more open to alternative investments. So there could be
like cryptocurrency, for example, like Bitcoin.
Absolutely, crypto. But there's research that's done that shows that those investors are much more open to private equity, venture capital, crypto, as you mentioned. So. And part of that is being solved by accessibility, right? So you have individual investors now have much more access to all those types of different alternative assets than they did in the past. They're more comfortable navigating through those. And so you could see some redeployment of, inheritance that might come in stocks and bonds that gets somewhat redeployed into different asset classes. I could see that coming. So that's one thing. Real estate, interestingly, in the same research piece that I had read about, is just as popular with the young crowd as it was for the baby boomers. So I think real estate is something that seems to be generational in terms of an investment. That's one that will probably continue to be a strong area of focus. So
I can't imagine these guys investing in gold.
Yeah, it'll be interesting to see how that happens. And even gold, I think generally for individual investors is less and less of a go-to investment. We'd had discussed a few podcasts ago that, we're seeing a lot of sovereigns buy the asset and bulk up their own balance sheet with gold. Maybe some of it's, a desire to have less reliance on U.S. Treasuries, but individuals themselves, I think there's so many alternatives. Gold has always been a little bit tricky. You don't get any yield. You don't have either storage issues, all that kind of stuff. So, I could probably see the younger crowds going more for crypto.
Yeah, I can see Bitcoin sort of over time. So I think the issue with Bitcoin right now is, as you've talked about before, it trades sort of similarly to tech products. But I think what happens to that over time is the market cap becomes, it becomes significant and becomes similar to a gold. It's probably going to become a lot more, a lot less volatile, and that's when it probably takes the place of gold. That's my quarterback economist prediction. But let's talk about the current market here. What's going on? What's new?
The new is pretty much the same as where we were last week. Markets are, still pretty robust. Equity markets remain near their highs. Bond prices are holding steady. Gold and Bitcoin, as we were talking about, still pretty close to their all-time highs. So, nothing dramatic over the last week. It's still robust. Nvidia had another blowout quarter that they reported last week.
Nvidia?
Yep. And so, so that is continuing to support the AI case. And you see that with not just the chip maker, but it's flowing down into all sorts of different industries, including all the way to utilities. Utilities on the year are up about 15 to 16% as a return on your investment from the beginning of the year, which is ridiculous, right? I mean, boring utilities should not be trading like that. But the idea is that the demand of AI is going to continue to push the need for an upgrade of the electrical grid, and utilities are poised to invest and make good returns off of that type of growth in that. So, it's affecting all sorts of interesting parts of business industry and that sort of thing. Overall markets are still assuming some rate cuts later in the year, but nothing dramatic.
Are they
this week?
So?
Yep.
So I'm curious on that. There was this, I guess, sort of a negligible drop, right, in CPI and inflation.
Yeah.
And I mean, help me understand why that seemed to change sentiment, because it just seems so small.
Yeah, because it was directional, Buck. I mean, at the end of the day, the markets are trading on expectations. And what they had was several months where the economic data was coming in stronger and hotter than they had expected. And so you saw markets kind of getting a little bit more choppy, a little bit more volatile. And then all of a sudden you had an inflation metric come out that was a little bit softer than expected, just a touch, but it wasn't hotter than expected. And so all of a sudden the expectations, swing wildly. It goes from people starting to think about, okay, does the Fed cut it all? Oh my goodness, could there be a scenario where the Fed actually increases rates later in the year? And then, you get the lower print, and all of a sudden everybody's like, okay, we're back on track. Fed's probably going to cut later in the year and that sort of thing. It's because all based on
the 10-year Treasury also dropped.
It did, but you're talking basis points, so it's not dramatic, but it's been holding in there on a yield. It's probably 4.5% today, so it's been kind of between 4.4, 4.5 last few weeks, so nothing major. We do have another inflation metric coming out later in the year, later in this week on Thursday, the core PCE, which is called the Fed's favorite measure of inflation because it actually excludes food and fuel, which are more volatile, and it kind of gives the more steady inflation numbers in there. So again, people are expecting that to be pretty much flat to slightly down at this point.
And job markets, all that stuff. There's the when does that news come out?
I don't think there's any job markets this week. I believe that's next week. I'd have to confirm that, but I don't think there's anything incremental on the job markets front at this point. But overall, there's anecdotal evidence there as well. Small businesses are not hiring as much. You've got larger businesses. You're hearing about layoffs here and there. So it could be cooling a bit, but. At the end of the day, the jobs market has different pieces to it, right? There's unemployment, but then there's also wages. I think wages for the next, several years is going to have a built-in inflation in there just because a lot of unions, whether it was in the auto industry, the airline industry, whatever, they all managed to negotiate, pretty nice lifts year over year for the next several years.
Is that right? Is that when that was done? During COVID or something, or when?
No, it was over the last 12 months. Most of this has come into place.
So how much lifts are we talking about?
It's going to be hard to project that into the numbers when you're talking about the actual overall wage increases, but the specific contracts, they were pretty significant. I mean, you were talking about anywhere from 25 to 50% kind of increases on some of those, like airline pilots, for example, got very significant lifts to their salaries.
Really?
When they negotiate. So some of those are going to be continuing to flow through over time.
It'll be interesting to see what happens with that. Then, all right. Well, one last question for you before we let you go. I remember you talking about junk bonds, and junk bonds are. Tell us what junk bonds are, and tell us, what you think of them.
Well, junk bonds, otherwise known as high yield bonds. I prefer high yield bonds because it sounds less junky, I guess.
It sounds less junky. Yeah.
I think junk bonds at the end of the day, it's an unfortunate name. What it means is that these are bonds that are rated below investment grade by the rating agencies. And even that terminology, investment grade, is a little bit confusing. Investment grade, all it really means is that you're at a triple B rating or higher. So you can have triple B, single A, double A, triple A, all that sort of stuff. All of that is called investment grade. A lot of very, very large institutional investors, they have a mandate that they can only invest in investment grade bonds, and so you have anything below that is what's referred to as junk. But I'll tell you, a lot of these companies are good companies that issue this, even though they can't support the rating of an investment grade rating. At the end of the day, there's probably a lot of companies that you would buy stocks of that would probably be categorized as junk bonds if they were to issue bonds, but we never think about that. But fact of the matter is, bonds are debt. They're higher in the capital structure than equity, and so they're more secure in that respect. What I'm trying to say is that they're not as bad as they sound. The way to invest in them is to invest in a fund, so a high yield bond fund, because it's very, very important to diversify your exposure here. But at the end of the day, you can get decent returns that
So what kind
be,
of returns do you talk about when you talk about, like, these sort of high yield bonds?
Well, right now, I mean, they are very much in demand because they give a bit higher yield than investment grade. So, whereas investment grade bond, you might get, let's say on a 5-year tenor, so a 5-year investment horizon on an investment grade bond, maybe you'll get 4%, 4.5%, something like that. A high yield bond might get you 6.5% to 7%. So typically you're talking about 2.5% to 3% higher than your investment grade kind of investments in debt. So you get a bit of an uptick, and that's the spread that you're going to get for taking the additional risk. But again, if you're investing through a fund, you can actually diversify that risk, and in the loss given defaults is very low in those situations, and you come out pretty well.
Yeah, so it's like for you and for your clients, I mean, like how do junk or high yield bonds, how do they fit into a portfolio? Are they a certain type of person who usually is interested in those?
Well, yeah, I mean, any investor that is looking to diversify across different asset classes, we will definitely bring up high yield as an important potential exposure. They tend to not be as correlated to the equity markets, so that's a good thing. And again, they're historically. If you're buying into a fund rather than a specific one name, right? Just like you wouldn't buy one name in the stock market, you're going to be okay from a diversification perspective. So it gives you additional yield. They typically have a coupon that they're paying. It might not be huge, maybe 3 to 4%. But at the end of the day, there'll be a pretty nice addition to a diversified portfolio, giving you equity-like returns. But it's higher in the capital structure and just a bit less correlated to equity.
Yeah, it's useful information. I know a lot of people are chasing yield right now, and maybe you don't find it in real estate right now. Maybe you don't find it in some of these other things. Certainly, there are opportunities. I think with this the aviation fund we've had and so on. But another option to consider, and people may want to reach out to Zulfi at Valerity Wealth. It's valeritywealth.com, right?
Yep, that's right.
Yeah.
Velerity.
Yeah, Valerity Wealth, VELERITY wealth.com. Zulfi, thanks for being on, and I'll catch up with you next week.
Sounds great, Buck.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.